John Wellborn, nice to see you again. Simon Catt from Arlington with John Wellborn of Fenix Resources. I'm sitting in my office in London. John, you're in home in Perth, are you?
That's right. I'm in the Fenix headquarters in sunny Perth.
John, you've been a rugby player. You've been a promoter of junior mining companies. You've run serious gold mining companies in Africa. Now you're in the iron ore business in West Australia. Is this a short-term thing or a long-term thing? Can you tell us what is Fenix and what's your commitment to the company?
Well, I'm the executive chairman, and I've tended to get involved in interesting team activities. You mentioned I was a professional rugby player. I played in a period of time where the Wallabies were actually the world champions, as long ago as that is, Simon. I've been an investment banker and I have worked in a number of mining companies, and the connection with those is working with really good people on what are challenging projects in a competitive environment. And I went to Africa as a younger man on the basis that all the good opportunities in Australia in such a mature mining jurisdiction would have been either secured or on their way to being developed, and had a lot of fun exploring and discovering and developing African opportunities. As a result of COVID in 2020, I was stuck here in Australia and had the great fortune of looking in my backyard. And at that stage, Fenix was a junior resources company with a very high-grade, small stranded resource in the midwest of WA. And since then, working with my fellow directors, Gary Plowright and Craig Mitchell, Fenix has brought that project into production. We're now producing 1.3 million tonnes per annum. And we've built two other key pillars, being, we're a mining company, but the key to unlocking those stranded deposits is the infrastructure, logistics and port. And so we've built really three businesses: mining, logistics and port services. And I'm all in. It's a really exciting journey. I love working with the team, and we're a small company building something that we think can be quite significant in the Midwest.
Gotcha. And so you mentioned Fenix produces 1.3 million tonnes of its own iron ore today. If we look into the future, how many tonnes of iron ore that you mine, truck and ship, or Fenix being fully integrated, a bit like a mini MinRes or a mini Fortescue, how many tonnes will you grow to?
I think you work backwards from the port as to what's the constraint to our production. The Midwest of Western Australia has been largely eclipsed by the Pilbara, which produces almost 1 billion tonnes of seaborne iron ore, as well as a whole lot of other commodities. The reality is that there are billions of tonnes of iron ore in the Midwest. They're not in the huge deposits that justify railways and have built the port infrastructure we see further north. Mount Gibson mined 50 million tonnes in the Midwest. We've acquired their infrastructure. We've got amazing port on-wharf storage and loading facilities, and we have an amazing road haulage network. And Iron Ridge is really just the first of a number of mines that we want to either unlock for ourselves or for our third-party customers. The answer to your question is that we're very confident our existing facilities at the existing port can do more than 10 million tonnes a year. And so that is a very strong ambition for us. We think that Iron Ridge is just the start.
And I understand Fenix is about a 200 million Australian dollar market cap company today. You've got no debt. You've got about 60 million Australian dollars of cash on the balance sheet. How much capital do you need to spend to get to 10 million tonnes streaming iron ore, mining, trucking, exporting a year?
Well, I've got to update you on one thing, Simon. We published our March quarterly activities report this morning. So the cash balance grew from the 60 odd million you mentioned at 31 December to 88 million and 31 March. So we added more than $25 million in the March quarter, and that just demonstrates how profitable we are, but also how measly and miserly that $200 million market cap you mentioned is, which is almost half cash. We're making money, and we've got, assets in terms of real assets, on-wharf storage facilities, loading infrastructure, rolling stock, trailers, rail sidings, stackers, unloaders, which I think is worth more than the market cap of the company. So it is really worth a look. We're begging for detailed research because I think it's a wonderful opportunity. I think your question was not, though, about our valuation or cash. I was just updating you. In terms of our production, we're working on adding to Iron Ridge with Beebyn W11 and the Shine iron ore mine, and stay tuned for those projects, but we expect to have those into production either late this year or early next year.
So John, just to repeat what I think you just said to me, so you could be producing 2025. How many millions of tons of iron ore a year might you then produce, truck and ship? Are we talking 3 or 4 or 5 million tons of iron ore?
Well, W11 will be a similar scale mine to our current operation at Iron Ridge. You asked about capital, actually, and Shine could be again. So that you would see somewhere between 4 and 5 million tonnes a year from our own mines. The answer to your capital question is actually these are relatively, they're quarry-like operations. At Iron Ridge, we raised $15 million from the market to build that mine. Most of that capital is actually the road to connect the existing Midwest road network to the mine site. We use a contract miner and a contract crushing and screening. Our haulage fleet is self-financed, and there isn't any other real capital items. So the exciting thing about having almost $90 million on our balance sheet is that the mining operations we're looking at are very easy to fund. You mentioned we have no senior debt, and we're adding to that cash balance every day.
Gosh, it's as cheap as anything I can think of, John. I mean, if you've got cash of $88 million and you generated around about $25 million in the last quarter, even I can do the maths on that. 4 times 25 is $100 million Australian of annual cash flow, about the same amount of cash on your balance sheet. That's 1 times cash flow. And yet the production, you say, is going to increase by 2 or 3 or 4 times in the next 2 years.
Well, I think sooner than that. The other thing about that quarter is we spent $9 million on capital as part of our growth investments, and we paid $5 million in tax, and we had a few other expenses. So it was a really good quarter, but iron ore prices averaged above 120 US, and they're currently, recently dropped below 100, but they're back to around 110. So we are in a volatile. I think the market's not irrational. I think they have seen Fenix as a small, relatively high-cost miner with a short mine life. I think the re-rate that has started, and I think has a long, long way to go, is recognising that there are literally billions of stranded tonnes all around us in the Midwest. We have the only viable and high margin available infrastructure to monetize those assets, and we're going to continue to increase that production. It's a really exciting opportunity.
So can I frame it at some long-term iron ore price, let's say $100 or $110 US a ton? Can I use a long-term margin of $50 a ton for the future 5 million tons of iron ore production? Is that reasonable?
Well, I think it's reasonable, but it's also backed up by evidence. Our cash flow margin in the December quarter was $105 Aussie a ton of production. In the quarter we've just finished, I think it was just below 100. It was $95 Aussie a ton. Now that was in an iron ore price that was averaging around 120 US. Over the 4 million tons we've mined from Iron Ridge, we've averaged more than $50 a ton Aussie cash flow margin, and we've seen iron ore prices fluctuate in that time from the 80s US all the way up to 130. So I think if you think that iron ore is going to go to 80 and stay there, then our margin would be less than 50, but it'd be, we'd have a positive margin. If you think that iron ore is going to stay around 100, which is lower than it is now and seems a reasonable forecast, then I think your sort of number is about right.
It doesn't make any sense to me that any company, let alone an iron ore miner in a tier 1 jurisdiction like West Australia with a successful track record, would trade at 1 times cash flow net of your actual cash and with growth ahead of you. Why do you think the stock market is pricing Fenix that way?
Look, I think I've said that. I think, I'm not sure there's many people out there. It is a conundrum. The largest mining companies in Australia are built on iron ore and currently are funded by iron ore. The richest people in this country and some of the richest people in the world are iron ore miners. But speculative investors have a very bearish view on iron ore, or either that or they have enough iron ore exposure through their investments in BHP and Rio and FMG and others. So I'm not sure the commodity attracts speculative investment. And I think, we're morphing from a successful development of an iron ore miner where we have 7,000 shareholders who invested and have done really well, to attract institutional investors who are more interested in us as an industrial profit generator through port logistics and mining. So I think that's hopefully, we've transformed this company in the last 12 months, Simon. So I think, the biggest challenge I have in having meetings like this is answering that question, which is, well, obviously, John, there's something wrong here. The numbers don't make any sense. So I sort of can't buy it because clearly, there's a cliff somewhere or something. Well, I've bought 15 million shares PA on market, and I'd encourage anyone else to have a good look. I think the market will reward profit and cash flow, and we've got a really exciting growth opportunity. Iron Ridge is going to keep going. We're focusing on maintaining the strength of that operation. We're going to add others to it.
Yeah, that makes sense. Sometimes you can't explain the share price in the short term, and it ultimately takes care of itself, particularly if you pay dividends, return cash to shareholders, and keep executing on your growth plan.
Well, I think one thing I didn't mention, obviously, I really appreciate your interest, Simon. The reality is we raised $15 million from the market in 2019 with a broker that no longer exists. And we've since paid back $65 million to our shareholders in dividends, and we've got almost $90 million in the bank. So no broker is pushing our story. No one's publishing research. We're not about to raise any money, and so they're not seeing a ticket. So, I've always shied away from people saying, we're undervalued because no one knows about us. I mean, obviously, I'm talking to you, and I'm banging the drum as much as I can. We're listed on the ASX. Anyone can buy our shares every day. We have traded in a band around 25 cents. It goes up when we pay our dividend, goes down after we pay it. I think that's going to change. I see a lot of value. I think, maybe it'll change as we bring online these new projects. If we're a 3 or 4 million tonne a year miner and we're, instead of adding $25 million to our cash pile each quarter, we're adding 50 or 70 or 80. I think clearly our market cap is going to have to respond.
Yeah, well, and at some point you can prioritize your cash flow into buying shares back or paying dividends versus growth, or maybe you can do both.
Yeah, I think we are going to invest some capital in the business, but certainly we've got a register that's has become very receptive to receiving dividends. We've paid more than 12.5 cents in fully franked dividends over the last couple of years. And obviously we're looking like we might have a very strong profit number at the full year, and the board will consider a dividend. But I agree with you that there is a strong logic in an aggressive buyback.